Welcome to the Registered Investment Advisor Podcast, where financial services marketing expert Seth Green interviews experts, executives, and top producers to share can't-miss tips on how they successfully manage their financial service firms, grow their businesses, create great relationships, and influence the industry. And now, here's your host, Seth Green.
All right. Good afternoon, ladies and gentlemen. Listen, today we have the absolute pleasure of interviewing Ed Mahaffy, the founder and senior portfolio manager of ClientFirst Wealth. And welcome to the RIA podcast. And Ed, thank you for joining me today.
Thank you, Karl. Glad to be here.
Mahaffy, that name, football, Brendan Mahaffy.
Yeah, I wish I could claim relations. It just somewhere along the line, I'm sure we are related. But there's an old golfer, John Mahaffy. You might remember from a few decades back. Not related to him either.
I do. My dad was a golfer.
Oh, yeah?
There's an autograph on my wall. You kind of see the bottom of it up there. That is Chandler Harper.
Okay.
He was 8th in the Masters in 1947.
Oh, wow.
And he won the PGA in 51, and my dad was his caddy.
Wow. What a story.
What 14. Yeah. Okay, listen, this is all about
That's
you
great.
today.
That's a great story. I mean,
I digress. This is all about you today. And so,
well, see, I'm tempted to drift into a discussion about sports. So I've got to discipline myself to stay on track here too.
It's always okay with me.
Okay.
But listen, Ed, can you tell my audience a bit about your educational background and professional certifications, and how those qualifications contribute to your expertise in wealth management?
Certainly. Well, I got a BSBA business degree from the Citadel, and loved Charleston. Was there for 4 years, and I got a major in business, and I think I might have gotten a master's in discipline without even registering for it. But it was
Citadel, I could imagine.
It's a great school, and I loved it. And then, and it, introduced me to business and how businesses operate. And then I continued on to the University of Arkansas and got a master's in business administration, and I furthered my education there. It was a great school, great professors, and really loved my time up there as well. So that's sort of how I got my foundation of understanding how business works. And then as we moved through time, I got the certified financial planner designation, as well as the chartered financial consultant designation. And then I joined the National Association of Personal Financial Advisors, which is a fee-only network of a few thousand of fee-only fiduciaries, no commission, across the country. And you have to submit a financial plan to peer review before it's approved. And so, that's sort of an executive summary of the education and the designations, and the certified financial planner. Of course, you're fully aware of the curriculum there. You go into investments and financial planning and taxation and retirement planning, and it's very thorough, and it just really helped me make the transition from being an institutional sales person for 10 years covering banks and insurance companies to the individual world, and so it's worked out very well.
So, and I noticed that you've written a book.
Yes.
Tell my audience about what motivated you to write the book, where they can get it, and some insights, some clever little insights that are in the book.
Sure. Well, the book's on my website. It's an ebook. It's download for free. But I wrote the book because after meeting with clients and prospective clients for 10 years, the same questions kept coming up. And I could just tell there were spots that clients really didn't fully understand. They understood some of, and maybe had a false sense of security of, the importance of, say, asset allocation and diversification, and the bond markets, the inner working of the bond market, and how that affected their portfolio performance. And so I covered, the book is called How to Select a Financial Advisor, the Least You Should Know. I also covered the difference between a fee-only advisor and a commission driven sales organization, also known as dually licensed, which was part fee-based and then part commission. And I was licensed like that before I became fee-only. And I wanted to make a break from that and just become completely fee-only. So there's no commissions, there's no well, I get paid 4 times a year. There's a there's a fee based on assets, and I explain that in the book. And then I have Morningstar exhibits in there, explain the time value of money, explain budgeting, explain financial planning, give examples of what saving even 0.5% in your investment management fees can do for you over time, over 30 years, compounded at, say, 6%. It's the figures are staggering. And someone said, and I can't remember who, but the things we do every day, Karl, make the difference in our lives. And it's those little insidious fees that accrue every day that you don't see, the internal expenses in the products that are being used, and things like that I just want to call attention to. And it articulates my vision of how I work with clients. It articulates my philosophy, the importance of diversification, like I mentioned. And it is something that clients have appreciated because I'm being held accountable to what I put in that book. And so it's a great thing if someone calls and they go, hey, I found you on the web. I want to have a meeting or want to talk. Don't even want to have a meeting yet. I'll send them the book, or I'll refer them to the website and let them download it. And then they can get a really good feel, what it's like to work with Ed and the rest of the folks at ClientFirst.
How big is your staff at ClientFirst?
I'm sorry?
Oh, how big is your staff at ClientFirst?
Well, I've got one associate, and then I co-own another firm like ClientFirst that's fee only. And the my partner there is also a certified financial planner, also a NAPFA member. So is my associate. So we all collaborate quite a bit. Even though my partner is not physically in the office with me here, we co-office, and we help each other a great deal. And so it's a small outfit, but we have utilized technology, and we've we outsource a lot. I outsource compliance, so that's a big time saver. I spend a lot more time with clients, but I have to limit, Karl, the number of clients that I can take in. Right now, I've probably got 110 accounts. There's probably maybe 60 relationships. And a lot of people have 2 accounts and what have you. And so we can certainly onboard some more. But the great thing today is you can find talent, as you grow, that accommodates the growth, and you don't lose quality control in the process. And so we hit growth spurts, but COVID, I think, to a lot of people too, sort of staggered the growth for a while. It's coming back now. People are sort of just in the last 6 months starting to express more interest. I'm getting a lot more attention and saying, hey, I want to talk. I need to come in. I got to do something. It's almost like it's been suppressed for 2.5 years, and now there's a release of the demand, for financial planning and investment management. And anyway, so
people start to question mortality.
Yes,
they want to look at those things.
Exactly.
So,
exactly.
Tell my audience where they can reach you, because I am sure you're going to get calls, emails, or however you want to be.
Sure.
Reached.
Well, my email is ed@clientfirstwm.com. And then the website is clientfirstwm.com. So very easy to reach me.
And I usually ask that question toward the end, but just in these first couple of questions, it's very compelling for people to reach out to you, and the fact that they better hurry up because you only take select clients. So I want to get them out there now. What
Appreciate that.
motivated you, Ed, to establish Client First? In 2007, I believe it was, after
Yeah, exactly. Yeah,
1.2
exactly.
decades.
That's correct.
Okay.
Well, I was at Merrill for 5 or 6 years, and then uh, I started an independent office of Raymond James, where I was a branch manager and uh, just a smaller operation, but um, independent. And I I saw the need, Karl, to be fee only and have what I would describe as total open architecture, where when you are working for another firm, you're limited to their products, you're limited to, their way of doing things, and you're limited to their cost structure. Because if they've got overhead that on my own I could avoid and save money and pass that savings on to the client, i.e., the name Client First, the fiduciary responsibility, and being able to, charge lower fees than these bigger firms, substantially lower, and still do a great job. And I'm happy, and I keep the overhead low. Well, I couldn't do that working for another company. And then, in that world, I wanted to leave the world of quotas and products and services that we encourage you to be, why aren't you talking to your clients about it? And so the flexibility, the ability to control cost, the desire to just want to be a full-time fiduciary, fee only. That's what really drove it. And it's been a good decision. I have never regretted it for a minute.
Rich, it was Stan O'Neill. I was
Yeah.
pretty good friends with Stan O'Neill at one point.
Yeah. Yeah. I was there when Stan O'Neill was there. Yeah. Yeah. He was probably, I think he succeeded Dave Kamansky, maybe.
He did. And
Yeah.
I think 2009 is when Stan left. Well, or kind of was forced away. Uh, I guess he got like 65 million on the way out.
Yeah.
Um, you can bend me over at the door and kick me in the butt with 60.
I, I never see any of those guys leave without a bucket full of money,
Yeah,
no matter
exactly.
what the circumstances, but
Exactly. Hey,
it's above my pay grade.
yeah, right. Can you provide a few more details to my audience about your roles and responsibilities as the president and senior portfolio manager at Client First?
Certainly. Well, first and foremost, my primary responsibility is to listen well to my clients. And that means on an ongoing basis, stay in touch, what's going on in their lives, how will it affect their financial plan, how will it affect their asset allocation mix. That's all my job. It's sort of like a pilot getting the weather report. You have to do that pretty often. And so that's the first thing. And then secondarily, the portfolio management, which is part and parcel to communicating with the client, because the foundation is to have the client articulate their risk tolerance. And that's so important, Karl, because I've had clients that so often have come in, or prospects that have come in, and I will show them their portfolio, and I'll say, now look, here's how we're allocated. Let's say, for example, the stock market's been going up and up and up and up, and we have the proper asset allocation based on the risk tolerance the client articulated. And the clients may be saying, well, I wish I were up a little more because the stock market's up more. And I have to remind them, what if the stock market were down 10%? And I stress test the portfolios. And they would say, well, I wouldn't mind. I'm a long-term investor. I can handle down 10%, no big deal. And I go, okay, well, if we increase your allocation to equities, you're going to have more volatility. How would you feel if you were down 20%? Well, I wouldn't like it, but I'm a long-term investor. Yeah. And then you let the market drop fast, about maybe 6 or 7%. And they're going, what's going on? So sort of to go back to the pilot analogy, you got to keep the wings level and know what's going to provide turbulence. And so, but I find there's a lot of what I call recency bias, which we all have. So, thus it shall ever be, whatever's been going on in the immediate past is sort of projected, into the future, that because the market's been going up, it's going to keep going up. And we sort of lose sight sometimes of what happens if that assumption is wrong. And, we have a mishap like we had in 2022, both in stocks and bonds. And in the bond market, that was the worst year for the bond market since the 1800s. I mean, yeah, off the charts bad. And I stress test portfolios. So the fixed income component of clients' portfolios was really in a good spot there. We didn't have the big losses, they were very small, very manageable, with great bonds and good steady cash flow. And nor did we have and I say we, because all my portfolios are pretty much managed, the same way. They're just customized to your needs, your goals, whether you're in the accumulation phase of life, in your 20s, 30s, 40s, or you're in the distribution phase, and you've got wealth transfer aspirations. Okay. But it's just a matter of what your allocation is. But my duties, back to your question, beyond the portfolio management, is to just make sure clients understand what they own and why they own it, so they're a great partner and they understand. Excuse me. They call me. And it's wonderful because they're very conversant with, hey, Ed, I know we've got this 6% allocation to small cap. And, it's some of them really enjoy, getting granular about it. And I love that, and they're the ones that want to read everything that I can send them. And others like, hey, Ed, how's it going? I'll talk to you again in 3 months. They don't want to talk about their investments that much. They'd rather be on the golf course, or they'd rather be, whatever they're doing. And then the rest of my duties are, just what one has to do to run a company. I mentioned the compliance. I'm the chief compliance officer, but I outsource that to a great company I've been using for 20 years. And, they keep me abreast of all the changes, the regulatory requirements and what have you. And I have to sign off on everything, and I have to fill out the forms, but they shepherd me through that process. And then just marketing, just making sure people are aware that you exist and what you do.
Well, you kind of took care of like the trends and the question, but given your experience and your wealth of knowledge, do you see some trends that are going to be beneficial to some portfolio holders, some of your clients?
Oh yeah, definitely. I see some that are.
Take all that crystal ball.
Yeah, I have no crystal ball. I first of all make that disclaimer. There's no crystal ball. I think you never bet against America. We have a bright future, and if you look over my right shoulder, you'll see a Morningstar chart, and you'll see a 45-degree angle from left to right. That goes back to 1926, and it's basically $1 invested up through present day. And there have been some pretty scary jiggles in there and periods where we were fallow for 10 years, 12 years. But ultimately we prevailed. That's the bright news. That's the good news. And stocks do a decent job of keeping up with inflation to a point. That said, I think I would not frame this as good news, but I think when you identify challenges and step into them and meet them early on, that is good news, even though it's not necessarily a money-making proposition. And I'm thinking specifically about the bond market and how to sidestep a punch, if you will, from fixed income. And Karl, I mentioned to you 2022 was the worst year for bonds in, since the 1800s. And there were, great bonds, treasury bonds, for example, that just got pummeled. The values fell, 30%. And you're thinking that's supposed to be the ballast in my portfolio. That's supposed to provide, the balance. And it was where the problem was coming from, because the Federal Reserve was just steadily hiking, and they seem to have leveled off now. But my biggest concern is that inflation is here to stay higher than it has been for years. I don't think we're going to go back, and I'm not an economist, but I don't want to get too granular as to what my rationale is here. But I think we're in a new range, and I think the 40-year bond bull market, or bull market in bonds, is over. And I really don't think we're going back to 0 or 1% or 2% on a 2-year note or 3. I think the path of least resistance is higher interest rates. And that's really not a good thing necessarily. At the margin, it's not a good thing for stocks, because there's more competition for stocks when the yields are higher on bonds. But I think the markets just acclimate as time goes on. When there's something new or a shock, there's more volatility. The range of reaction is much wider, and then we sort of get immunized to that. And that's what the stock market has tended to do here with these rates, because here we are at almost all-time highs. The stock market has been very resilient. But I think going forward, if we have another ratchet up in rates, we just printed like a 510 or 505 on the 10-year note. If we see that exceeded, we've rallied back down to about a 417 yesterday. So price up, yield down. If we see that reverse and we go back and we set new highs in yield, and we go to say 5.5 on a 10-year treasury, or 6, I really think that's going to be problematic. And my mission with clients is to make sure, especially new clients that come in the door, make sure that we don't own bonds that are too long in duration, too long in maturity, where clients are unpleasantly surprised if those rates do go back up. And part of my rationale for that position is that we owe more now debt to GDP than we have since World War II. And we, up until a year and a half ago, we weren't paying anything on our debt. The new debt that was issued we were issuing 2-year treasury bonds at 15 basis points. And just recently we issued some above, 5. So what's going to happen now on a $33 trillion debt, which we have, and about 52% of that debt has yet to roll over. There's still 2-year, 3-year treasuries out there paying almost 0. They're going to roll over into this higher rate environment. The Treasury will have to continue to issue bonds, and we're going to have $1 trillion, maybe $1.2 trillion, $1.3 trillion, just interest on the debt, additional expense, and that's competing with the national defense budget. So, and all the the other expenses that we have. I think that, at the margin, the path of least resistance is rates higher. And I'll say this and move on. But to my way of thinking, the Federal Reserve is sort of in a box here, because if they lower rates, inflation is going to get fanned and probably get more aggressive. If they continue to tighten, they may push us into a recession. And in the recession, what are they going to do to correct the recession? Lower the rates. You lower the rates, and here comes the inflation. So they've sort of painted themselves into a corner. And maybe I'm not giving them enough credit that they can stick the landing here. But my gosh, what a landing that would be! I don't see how they do that.
Right. That's impressive. Are there any specific publications that you refer to gain this insight that you could tell my audience about?
Well, I'm a voracious reader. I'm up at 4 every morning, and that's my reading time. I'm like 4 to 5:30. I'm reading periodicals. scanning the news wires, reading white papers. I've got a great relationship with JP Morgan, Vanguard. So their research papers, the white papers that they put out are excellent on a multitude of topics, from taxation to bonds to equities to you name it, alternative investments. And so that's sort of the raw material that I use for the investment management portion. And then every day I'm buying and selling bonds for individual bonds for clients. I've been doing that for 40 years. So I'm very plugged in to the markets. And of course, also equities, but I'm more passive on the equity side. I'm more like a Jack Bogle that says, don't look for the needle in the haystack, just buy the haystack. That doesn't mean you don't have a sleeve where you own little NVIDIA and, Meta, formerly Facebook, Google, some of the, or whatever your bent is to try to harness a little extra growth, but it needs to be looked through the prism of the overall asset allocation, the overall volatility, and you have to be pretty selective about how much money you put in, those type of securities. But
it's interesting. You mentioned publications and things that you read, but you should be one. I know
that's your heart, Karl.
You were recognized in Arkansas Money and Politics as one of 2020's best financial advisors in the last couple of years. You've been in Forbes.
Well, I've been interviewed by the Wall Street Journal.
Wall Street Journal, there we are.
Yeah, 4 times in the last 3 years for fixed income for bonds, and then I've had a few articles published in Barron's. That's maybe what you're thinking about. And most recently, one in August of this year, August of 23, an article on municipal bonds published in Barron's. So, I love to read. And then I think people suffer through my writings, but I enjoy it. And it keeps me very plugged into what markets are doing. And, it's sort of like going to class every day. If you miss class for 3 or 4 days, you're lost for a day or two until you better make sure you've got your bearings before you try to do anything, and make sure that you're fully aware of what's going on. Because if you don't, from a portfolio manager standpoint, if you don't know where value is, then you're not going to make good purchases or good sales. And, you have to know what something is worth, within reason. I mean, you're not going to be able, no one pinpoints it exactly. It's worth, a bond is worth what someone will pay at a given time, but you don't have to trade that bond that day. So we're just to kind of put that in perspective, just recently, yesterday and the past few days, I've been taking tax loss swaps or making tax loss swaps for clients where they may have a little bit of a loss in a municipal bond or a treasury bond, and and I love the individual bonds because, as opposed to the mutual funds, because they have actual maturities, and individual bonds don't charge fees like mutual funds do. So I can control the process more, and it aids in the financial planning process as well. Excuse me, but I've been doing the tax loss swaps where you might sell a municipal you have a small loss in, and then buy a different municipal, and you use that loss against a gain that you have for the year that otherwise would be fully taxed as a capital gain. So this is the time of year for that. And like I say, you don't have to trade a bond. You put a list of bonds out for the bid, and maybe half of them have great bids, and you trade those, and you wait to trade the rest of them another time. And I do a lot more observing than I do trading. I'm watching, for 80% of the time, and then replacing bonds that mature or get called, or maybe there's a swap where we feel like it's advantageous we've got a bond coming due in 6 months. We can go out now 3 or 4 years and get a little extra yield. Let's go ahead and sell the 6-month bond. And again, I'm fee only, so there's no commission involved there, where there's no there's no money falling through the cracks like there would be in a markup situation.
Okay, gotcha. It sounds like you really pay attention to your client holdings As opposed to right before you're, going to have the 6 month review with the client. The last couple of days you'll look at it, but it seems that you have a
I-
daily attentiveness to your client needs and what
You're
benefits the
so
client.
you're so right, Carl, and that's the only way I can do it. I cannot fail to look at something for 3 months and then come in the night before a meeting and just sort of brief myself with it, because I, I'm I can tell you, not perfectly, but almost perfectly, which clients own which bonds and
Oh,
what maturities they are and that sort of thing. And it's not because I'm a savant. It's just because if I am not immersed in it, I'm not very good at it. And I want to be the best. I don't want to be average or mediocre. And I think one must, you know, fully immerse themselves into whatever daily activity you're doing. And when you're talking about markets that are influenced by everything from, geopolitics to legislation to interest rates to, just any number of things, there's so many variables. And to kind of seine through all that and understand how, that day, that week, that month might be the beginning of a trend or the end of a trend and that sort of thing, and how that might filter down into clients' portfolios. You need to know what they own. And like I said, a lot of the portfolios that I manage, they're not ubiquitous, but they have very similar securities. It's just a question of what percentage of the various securities each one owns that dovetails with their risk tolerance and goals and that sort of thing.
I want to can you explain the significance of your membership in professional organizations like NAPFA and
Sure.
FPA?
Yeah.
And,
Well, NAPFA, NAPFA is an organization of, I'm not sure how many thousand, but several thousand fee-only advisors, registered investment advisors across the country, and investment advisor representatives that work for a registered investment advisor. They're fee-only, obviously. And I was attracted to that organization because you have to submit your financial plan to peer review, in order to be accepted. And there are some other qualifications, but also because there's a great sense of community, because there are not many as a percentage fee-only advisors in the country. Most advisors are dually licensed, where they're still, paid by commissions. They're not necessarily acting in a fiduciary capacity 100% of the time. And that's not a bad thing. It just needs to be fully disclosed. And I look for organizations to align myself with that try to articulate the differences in the economic models that a fee only advisor has, fully transparent. I get paid, I told you earlier, 4 times a year, based on the valuation of a client's account. And so NAPFA was great. And there's a great sense of community there, because you share articles, you share experience. NAPFA magazine is great. They bring a lot of things to the forefront that I might not have been aware of had I not been reading that magazine. I might have been aware of it a month later. That's a great organization. And it's also a way to raise your profile with prospective clients, because you can have a profile on NAPFA, and within your zip code, people go and they go to the fee only website. They see an ad for NAPFA, and there may be 3 or 4 advisors in your zip code, and they'll see, Karl McKinnie, registered investment advisor, Ed Mahaffy, registered investment advisor, Jane Doe, and you can call them all, you can go see them all, you can, pick one and start the conversation. So it sort of narrows down the search. And one thing's for sure, and this has been very helpful to me, when clients find me 9 out of 10 times, they've started to learn the word fiduciary. It's in the lexicon now. The first thing out of the mouth is, you are a fiduciary, right? You're fee only, right? Yeah. Okay, well, I'll come talk to you. And but it's helpful because it is a way to sort of, you don't want to waste people's time, and I don't want to waste my time. So if they don't appreciate that, and they're not looking for that, fee only experience, then I need to tell them up front, I'm not the person for you. If you want fee only, please come back. But right now, if you don't, then I can't help you. But anyway.
Listen, outside of your professional life, it's mentioned you enjoy things like reading. Well, you mentioned you're a voracious reader, exercising, and Crave Maga, or am I pronouncing that right, or am I just
Krav
Krav
Maga?
Maga?
Krav Maga.
Okay, tell my audience. Well, how about tell your host a little about Krav Maga?
Okay, Krav Maga was invented to train the IDF, the Israeli Defense Forces, and it's an amalgamation of various martial arts. I may not be translating perfectly, but Krav Maga translates into contact combat, like hand to hand, and it's, I've never been in hand to hand combat, Karl. I hope I never am, but I just, about 5 years ago, I've been a runner all my life. I've been active in sports and what have you. And I thought, this looks really challenging. I'm 64 now, so you have to be flexible to an extent, and then you're to just know how to handle yourself in situations. It's a dangerous world out there. If you're trying to protect your family or whatever, it's better to know something. And I found it great. It was a great group of people, and we trained hard together. I still do. I'm still training. COVID interrupted it for a couple of years, but I'm working on my 4th of 6 belts right now, and I love it. And so it's a challenge, and it's a mental challenge to me, because when you're, facing an opponent, you don't know what they're going to do. You don't know what they've got in mind for you. And so even if we're going half speed and just sort of, going through the motions, it's just a chess game, and it's interesting, and it's physically demanding. So I need all of the above. It's a great release. That and gardening. I didn't put gardening, but I grow a mean tomato, Karl. Okay. I really do.
Yeah. We have somewhat of a garden here. My wife and I do herbs.
Oh, yeah?
The Krav Maga. Yeah, we love to cook. So, we have our own basil and all our own stuff out there.
An herb garden and everything. Okay. Yeah.
Oh, yeah.
Fantastic.
The Krav Maga, I get it's better to have it and not need it than to need it and not have it, just in case you're in that situation. My son was a Marine.
Oh, wow.
And they have a particular kind of hand to hand, and he the way he explains it is it's not pretty like what you see on television. It's just crush it, kill it, and walk away. You just get it done and go home to your family.
Yeah. Okay. And the training it's basically don't freeze, something, your training will come back to you. And it's great to know just how to do a few things well. So for example, your loved one is walking across a parking lot and they're accosted by someone and whatever. If they're grabbed in a certain way, it's just good to know how to get away from the attacker. That's the whole point of Krav Maga. It's self-defense and then get away. So you're striking the eyes or, some sensitive spot, just to get that second of reaction to where you can get away. The women in my family are not very big, they're 5'3", 5'2". So I think about them, and there were a lot of women in the class. the first class that I took, the Krav Maga class, that were there for that reason, because they just want to have a little more confidence about what to do. And if you can just remember one thing to do under stress, under stress, you can't have step one, step two, you really just need one thing that just like you're scratching your face, it just comes. So it's been good for a lot of folks for a long time. It's been around since the 1940s.
Well, I'm 64 with you.
Okay.
And we're not gonna wrestle around with some guy for 15, 20 minutes anymore.
No.
So that Second Amendment thing is pretty good.
Oh yeah.
It requires very little energy, and you get to
That's exactly. You don't need Krav Maga if you're carrying a weapon. That's it's a different situation.
Oh, yeah. As long as you're doing it legally and protecting your.
That's right. Yeah, that's
So,
yeah, definitely.
listen, sorry we digress. I am really
fine.
enjoying this interview here.
So am I.
And I mean, I had a list of questions. You've seen them. You've answered the questions in the other questions. It's just
Okay.
tremendous. And,
Okay.
So one thing though, can you give me some examples of the types of clients that you typically work with?
Yeah, they're great.
And also, can you show us your book again too?
Oh, certainly. There's the book. Yeah.
How to select a financial advisor, and at the bottom of every page it says pick Ed Mahaffy, right? As you go through.
Exactly. That's what's in here. When you read that, that's exactly right. Yeah.
It's
And you notice it says the least you should know. So all the answers are not in this book or any other book I could ever write, but that's I did pour my heart and soul in there for about a year and a half, and that's as good as it's going to get from this author. It's pretty good, I think, for its purpose. But back to the type of clients, because I am small, I have to be fairly selective about clients. So I have according to my SEC filing, $500,000 account minimum, and some accounts are much larger than that. Some are right in that area, and each one of them is very valued and plays an integral role in ClientFirst, because you need a balance. It's sort of like an ecosystem. You need some people that are in the wealth accumulation phase and don't have a lot of money, but they need more financial planning. Or maybe some people don't have any money at all. They're just starting and they just want to pay for a financial plan, and they just want to check in with you once a year. Hey, I'm on track, and those are the younger folks. They're just starting out, the young professionals. And then we, evolve over the spectrum of, clients to where you're in the retirement phase and you want to live a certain retirement. And then you also want to know what's going to happen, to your money when you pass away. So there are any legacy transfer issues that you have or aspirations that you have, we can address. And I've got just an incredible relationship with CPAs, trust and estate attorneys, through which I've received a lot of referrals. A lot of my book has come from those other professionals. So we've kind of evolved into being almost like a family office without really being a family office. I've got fee-only insurance professionals. I've got the CPAs. I've got the trust and estate attorneys. And I've got several of them to where, I'll refer a client, or I'll pull the CPA in for a meeting, or get them on the phone, when the client's in the office, and they'll find one they like. They'll find a personality that they work well with, and is normally the first one I recommend, because I pretty well size up the type of personality the client is and match with some of the CPA personalities that I know, or the trust and estate attorney, they need wills, they need trusts, that sort of thing. And you can really help clients that way, because I run into this constantly. And this is not addressing your question directly about the clientele, although that I pretty well have exhausted that answer. But asset titling, so many prospects come in here, or a client that's been with me for a few years and they transfer more money. Hey, Ed, I've got an account at another firm. I want you to take it now. I want you to manage everything. And it's not titled properly, or that's really not the right description. But it's not titled in a way that would allow those assets to escape probate. Very simple thing to fix. You can use a trust. You can change from Karl McKinnie to Mr. and Mrs. Karl McKinnie. So, he's a joint tenant with right of survivorship and escapes a probate. Just simple things like that can be an unpleasant surprise. And, sometimes you have the conversation with clients, and because it kind of pertains to their death, they really don't want to talk about it much, and you bring it up again and they go, yeah, we talked about that. I'll get to it. And somehow, they don't. And so you have to really pay attention to that, because that could be, it's an easy thing to fix. And
Attention
yeah.
to detail on behalf of the client. Huh? Your attention to detail on behalf of the client. Not just get your fee and run away. You're really buckling down on what benefits your client.
We try to. We try to. I mean, that's I'm not doing my job if I don't do that, Karl. And so that's the way I've always approached it. I was looking at a note here that I had. I think I covered that. I hope I did. You tell me. You asked the question. Yeah. Did I answer your question properly or yes, extensively enough about the type of clients?
There's no right or wrong answer. It's Ed's answer, and your answers have been great. I love it. I do this. I co-host with Seth and Kevin on the Sharkpreneur, and co-host with Seth,
right,
the RIA podcast. And
yes,
this is great. Sometimes it's a struggle to get the information that I know my audience wants to hear.
Yeah,
and you've done a great job. And just kind of a last question. Given your success,
yes,
tell me what challenges you still have to overcome today.
Well, the biggest challenge is always just communicating with the client and making sure you're hearing what they're saying about their risk tolerance and what have you. I don't want to, sound like a broken record, but that's the biggest challenge. And then from a portfolio management perspective, my gosh, I mean, there's nothing that isn't challenging with the bond market the way it is, and the stock market the way it's like, when my kids were small, we went to Orlando, and I think it was Universal, and there's this attraction called the Tower of Terror, and it'll go up and then drop like 3 stories, and you think you're just going to hit the ground. And so it's sort of been a Tower of Terror a couple of years. And so that's always challenging. And then just, balancing my faith and my family are first with me. And so the carving out the time to do those jobs right, not that faith is a job, but to have the time to devote every day and to be able to be there emotionally for your family, as opposed to when they call in the middle of the day, and they need something, you got to be there. You can't say, I'll call you back in an hour. I'm in the middle of and so you just need to have that in mind when you go through the day. And there have been days, honestly, when, I've learned the hard way that I was too involved in doing whatever I was doing. And they don't call often, but when they do, I like to be there. And we're a real close-knit group. I've got 2 children. My daughter just turned 30. My son just turned 28. And so they're grown. They're out of the nest. And remarkably, my wife has not kicked me out of the nest since they've left. She says she's going to keep me around for a while. So that's a good thing.
That's a good thing. Yeah. That's managing that work-life balance.
That's right. That's right.
I absolutely understand. My children think my middle name is ATM, and they're all grown.
Well, my middle name's ATM.
I think they can push buttons and
money
will come out.
I understand. Yeah, but I wouldn't have it any other way, right? I mean,
absolutely. We complain about it, but we love it.
That's right.
Listen, I want you to share with my audience once again how they reach you.
Sure. Well, my email is ed@ clientfirstwm.com or ed at clientfirstwealthmanagement.com. Either one, get here. And then the URL for the website is clientfirstwm.com or clientfirstwealthmanagement.com. And I'm in Little Rock, Arkansas. I'm on the 7th floor of the Prospect Building. So it's not hard to find me, Karl.
Right. And guys, you can always reach out to us, and I will certainly send you over.
Thank you.
This is Karl McKinnie, co-hosting the RIA podcast with Seth Green. Today, we've had the pleasure of having Ed Mahaffy from ClientFirst Wealth Management. Ed, thank you for your time today.
Thank you, Karl.
It's my pleasure.
It's been a pleasure for me, and thank you so much. It's just really been a pleasure, and enjoyed every minute of it. And congratulations. You don't really pat yourself on the back much, but I know you recently were inducted in the Hall of Fame, and you might want to share that with your audience as well. So, not trying to overreach here, but you need to.
Well, thank you for that, Ed. This is. I get yelled at because sometimes I fall into discussions about sports, and yes. Seth goes, "Oh, you start talking about yourself too much," because it's about you guys. It's about our guests, and this is your time to shine. But I do thank you for the compliments.
God bless. Thank you.
49 faces looked to him in triumph. Over the last 12 months, they had each taken turns and promoted his business for a week at a time, driving over $987,342 in revenue. What if you had a network of 50 centers of influence who promoted your business every week for a year? Grab your copy of the #1 Amazon best-selling book, The Ultimate Guide to Growing Your Business with a Podcast, at 33% off the Amazon price by going to ultimatepodcastbook.com. Again, that website for 33% off the Amazon price is ultimatepodcastbook.com.